Welcome to this educational session on, whether you're a student, a trader, or just curious about financial markets, this video will help you understand the core ideas behind these financial instruments in a simple and clear manner. Let's start with the basics. Futures and options are types of derivatives. That means their value is derived from an underlying asset. This asset could be a stock, a commodity like oil or wheat, a currency, or even an index like the Nifty or the S&P 500. A futures contract is a legal agreement to buy or sell an asset at a predetermined price at a specified time in the future. For example, say today is June 1st. You and I agree that on August 1st I will buy 100 shares of a company from you at 500 rupees each, no matter what the market price is on that day. That's a futures contract. Both parties are obligated to fulfill the contract on the settlement date. Now let's understand options. An option contract gives the buyer the right but not the obligation to buy or sell an asset at a certain price before or on a particular date. There are two types of options. 1. Call option gives the right to buy. 2. Put option gives the right to sell. For this right, the buyer pays a premium. Let's take a real-world example. Suppose you think the stock of company A will go up from 500 rupees to 600 rupees in a month. Instead of buying the stock outright, you buy a call option with a strike price of 520 rupees, paying a premium of 10 rupees per share. If the price goes to 600 rupees, you exercise your option and profit. If the price stays below 520 rupees, you let the option expire, and your loss is limited to the 10 rupee premium. On the other hand, futures are riskier. If the price drops, you still have to buy at 500 rupees, possibly incurring large losses. Futures and options are widely used in stock markets, commodity markets, currency markets, and interest rate management. They serve two major purposes. First, hedging to reduce risk. Second, speculation to profit from price movements. It's important to note, futures involve higher risk, but also higher reward potential. Options provide limited risk for buyers, but can be risky for sellers. Both require knowledge, strategy, and awareness of market volatility. In India, futures and options are regulated by SEBI, the Securities and Exchange Board of India. Globally, organizations like the CFTC in the USA and the FCA in the UK play similar roles. Trading occurs through exchanges such as NSE and BSE in India, CME and NYMEX in the USA, and LME in the UK. To summarize, futures are obligations to transact at a future date. Options offer the right without the obligation. Both are powerful tools when used wisely, but they're not for the faint-hearted. Risk management is key. Always learn, practice with virtual accounts, and consult certified professionals before entering derivatives trading. Thanks for watching. If you found this helpful, feel free to share it with someone who might benefit from understanding the world of futures and options. Stay curious, stay informed, and keep learning. Until next time, this is Professor Rahul Jain signing off.